Hello, everyone out there in Facebook land. This is Andrew Berman from National Mortgage Professional Magazine. Thank you for joining us for another Mortgage Leadership Outlook. We've been blessed by having some amazing people joining us to discuss about the impacts of coronavirus, the overall crisis. Today we're blessed to have David Stevens. So David H. Stevens, CMB. Don't want to forget the CMB. Spent a lot of time actually getting that designation. Don't want to actually leave that off. But David's going to be joining us, and I'm sure most of you are pretty familiar with David's career. I mean, so this is a guy who actually has been a career mortgage banker and I wrote down some notes here, so I didn't forget anything. So senior vice president, World Savings Bank. Executive Vice President, Wholesale Lending at Wells Fargo, Senior Vice President, Single Family Lending at Freddie Mac, also President and Chief Operating Officer of Long and Foster Real Estate. And additionally, he was an Obama appointee, served as the Assistant Secretary of HUD, of FHA, and the U.S. Department of Housing for HUD. I mean, so any one of these things would have been an amazing accomplishment, but you've got your resume filled with so many great things, and we had you on today because David, you've just been on the front lines of this. Have had actually ongoing dialogue, with the government, talking about actually the response. So, thank you for joining us, Dave.
Good to be with you, Andrew.
Yeah. So listen, I've got a couple of different questions that we've prepared, and if anyone has any questions, I am going to be monitoring, Facebook chat. So please actually, go to our Facebook chat and ask any questions you might have. So I want to start this off, if you don't mind. I want to talk about some of the things that that you feel actually that the administration has done right in terms of the response, and then we could talk about some of the things that you maybe don't disagree with, or don't agree with, I should say.
Yeah. So it's always funny about Washington. The administration it depends on how you define what that is. There's the administration, there's other regulators, and then there's Congress, right? And so the administration, to me, has always meant the president and his cabinet officials. So that's HUD, Treasury, anything that comes out of the White House, OCC. Well, actually, I would just stay with the core regulators that deal with our world. And then obviously Congress got involved, and the Fed's been very active. And then there's the FHFA and the GSEs. These are all kind of the core players in the world we're living in right now. I mean, the good news is the way I put this in perspective, and I've said it to multiple audiences in the past many days, this virus, came on us like a ton of bricks. I mean, it was literally 3 weeks ago. We were all planning vacations and traveling and, not expecting to be where we are today, hunkered down in our homes. And the news seems to be getting worse. So it's been an extraordinary period in time that's brought, incredible angst and fear and everything else that comes with this unbelievable situation we're in, dealing with this coronavirus and having to watch the news with shock and awe every evening as we see the numbers increase and worry about our families and friends and everything else. So what I think Washington did well is in a few pockets. One was getting together and passing a huge bailout plan. And that was really needed to put interventions in place to help people who run small businesses with unemployment, particularly extending unemployment, things to help with home ownership retention, and a variety of other supports to help keep America at least somewhat cushioned from this massive blow. Now, there are problems in implementing all of this stuff that's going on right now. The small business challenges are extraordinary. And that's actually, front page news. You're going to see it probably in tonight's news and over the weekend from major media, focusing on the lack of effective implementation of relief for small businesses, despite the legislation. But getting the legislation passed in such a short time frame, very bipartisan, getting it signed into law, that's a big deal. Second one was the Fed. The Fed has been extraordinarily responsive. Some may argue a little too responsive, but a few weeks ago, in the very beginning of this, a couple of weeks ago, we had a huge problem with excess supply of mortgage-backed securities in the marketplace. This has nothing to do with pipeline hedges. That was what happened as a result of the involvement. But holders of mortgage-backed securities, real estate investment trusts, global holders, they were repositioning their holdings, essentially selling them. And in the process of that, we didn't have buyers in the marketplace. So rates started backing up, prices were worsening. And a lot of these folks, particularly REITs, were at great risk of having margin calls on their positions on their MBS holdings. And so to even out the excess supply, the Fed immediately jumped in, started buying mortgage-backed securities in a big way and bought treasuries. They made a strong commitment. That eliminated the excess. And we saw prices, increase by about 600 basis points on agency MBS in just a matter of a couple of days. So yeah, that was really impactful. Unfortunately, the backside of that was everybody who had a pipeline hedged of current production, their short positions got crushed and they started dealing with margin calls. But then the Fed responded again. I mean, they heard the pain. We were at risk of truly many of our, particularly non-bank originators, potentially being in severe trouble. And the Fed ended up slowing down its purchases, leveled out the MBS market. In fact, prices even worsened a little bit for a day or so. And while a lot had to pay millions of dollars in margin calls, at least it looks like for now, hopefully for the remainder of this month, we'll be able to fund pipelines and make it through without having any more great risk of institutional failure due to margin calls. And then hopefully we have good fortune on the back end when those trade, that there'll be great value on those mortgages when they trade into securities. So, that was just another intervention. Ginnie Mae stepped in a big way. Ginnie has a liquidity facility that they have always had where they could make advances to MBS holders in times of distress. And you have to be, the policy was you had to be technically in default as an institution, and then Ginnie could step in and make advances to the MBS holders on loans that were in default at the time. That's been a shelter provision to make sure that bondholders will always get paid, even if an issuer is not able to do so. But in this case, because of forbearance that is being rolled out, Ginnie made an announcement that they would broaden the use of that capability, that liquidity platform, and expand it beyond institutions that are technically in default, that you do not have to be in default to be able to take advantage of that. That could prove itself to be an extraordinarily important lifeline for servicers based on what it looks to be a fairly big take up on the forbearance plan. So those are a few of the good things. And there are some things that didn't go quite well. I'd be glad to talk about those if you want to move in that direction. But, again, the administration is overwhelmed. Policymakers are overwhelmed. This has happened in such a short period of time that I give them credit for moving fast. I also am extremely concerned about what is not being done, because the other shoe to drop right now is this forbearance program, what it's going to mean to liquidity needs for the mortgage banking industry to make advances to bond investors, both in the Ginnie program and in agency MBS. And if something isn't done there, that could cause huge problems.
So give us an idea. You being actually a government background, you understand the industry of multiple roles. What would your suggestion be? I mean, if you're, listen, Jim, you're given the reins right now, and what would your calls be? Yeah.
So first of all, this is very fixable, but I'll tell you what's shocking to me. So I worked in the Obama administration. I came in 2009. It was the peak of the challenge during that recession, and we were always worried about moral hazard. I mean, we were concerned that any policy we initiated, it had to go only to those that needed the support from the U.S. government, because we didn't want to be accused of socialist activities or all the things that the Obama administration got accused of at its worst. And so we would have extensive meetings about how to make certain that when we implement programs, it went to those who needed it, but it wasn't a bailout to those who did not need it. So the way we implemented forbearance back in that period one, you had to prove hardship. You don't, everybody doesn't just get it as a free hall pass. You had to prove hardship. And two, it didn't mean that there wouldn't be a special code on your credit report or some reporting of the fact that you're in forbearance. Well, you wouldn't go into foreclosure during forbearance, and you would be put in a position if you came out of it that you could, depending on what program you were in, get back on track. It wasn't just a free pass. This time, this administration went so far, much farther than we did in the Obama administration. And they said, look, anybody who has a mortgage that's insured by the programs under Ginnie Mae, FHA, rural housing, or VA, or if you're in a Freddie Fannie loan, all you have to do is say, you want the exemption and you get it. And not only that, your credit won't be harmed. And I encourage any of you,
USDA too, right? USDA too.
And USDA, thank you. That's rural housing is what I was referencing. And so the outcome is outrageous. I mean, we have nothing controlling, no governor over this process to make sure that we're not just blanketly giving out taxpayer guarantees to people who don't need it, who are still getting paid, can make their mortgage payment. They can use this as well too, and not have any impact to their credit standing. And to me, I view that as excessively irresponsible. This is a taxpayer program. We should be supporting families who need it the most at a time like this, but not just using taxpayer funds in an excessive way like this did. The problem is, as a result, in the servicers that I'm talking to in the first couple of days of the month, they've had outrageous numbers of people signing up to come onto the forbearance plan. And why wouldn't you? I mean, with all frankness, I mean, I can tell you why I'm not doing it and why I wouldn't, because I don't want to have my balance go up and I want to pay off my mortgage. But for many, they're taking advantage of this sort of free put to not have to make their mortgage payments. Problem is that for servicers, they have to make advances to the MBS holders, and because this won't be counted as being in default, you can't pull loans out of pools in a couple months. These are loans that are in forbearance. They're considered for performing, and while there'll be ways to pay that back, and that'll be different for Fannie Mae, Freddie Mac versus the Ginnie Mae programs, there's going to be billions upon billions of liquidity needed to make advances solely because Congress passed a piece of legislation and that the president supported that created this extraordinary burden thrust on the backs of private industry without any consideration to what that meant. I'm just going to give you one perspective in terms of dollars. If 25% of all eligible mortgages take advantage of this forbearance plan, that's going to equate to about $70 billion over the first 6 months that's permitted under forbearance. So it's 180-day forbearance, can be extended for another 180 days. And as a matter of fact, if you extend, take that $70 billion, it becomes $140 billion of liquidity needed by our servicing industry to make those advances with no money coming in from anywhere. Servicing in last fiscal year, in last year's tax year, made about $10 billion all in. So we're talking $70 billion in 6 months in cost, $140 billion if they opt for the year. The private industry does not have the money to make these advances. It's completely outrageous that this program would be created without something in place to back it up. What would I do if I had the pen? One, I would have fought tooth and nail against allowing a forbearance plan that didn't require proof of hardship. We should be helping any American who owns a home who cannot make their payment because of job loss, income curtailment, furlough, whatever it may be, and we should help them get through that period. But nobody else should have a chance to get free money from the American taxpayer at a time when we all should be giving and sharing and helping. There should be nobody taking advantage of this system, but that is going to happen. And so that's mistake number one. I actually believe that could go back, that could be changed. It couldn't be changed retroactively, but it could be changed prospectively if they can if policymakers can go back and look at it. But let's assume that doesn't get changed.
Yeah.
And it remains this free thing that's going to cost billions upon billions of dollars like we've never seen before. Then what do? The administration set this up. They have an obligation to provide liquidity. These are not high risk assets. These assets are ultimately, the vast majority, going to reperform. And so there are two things that can be done. Freddie and Fannie could each set up a liquidity platform where they make advances to the investor on behalf of the servicer, so that the servicer doesn't have to dig up all this money. Fannie and Freddie don't have unending capital, but they do also have a $240 billion line of credit that's held by the Treasury Department. And ultimately, the Treasury Department could use their authorities just to make certain there's additional liquidity as needed to back up this facility. Ultimately, in the end of the day, in the GSE programs, those monies will get paid back through one of several measures that we need to hear from the GSEs in terms of exactly how they're doing it, whether they tack it on as a second, whether they modify the loan or modify this into a new loan, or they set up a separate payment plan, as it were, for the borrower to repay those monies. They will have a way to pay that money back. And in worst case, it gets paid back when the home is sold or the loan is refinanced. Ginnie, same thing, right? 6 months of free advances. Those have to go to the investor. Extraordinarily expensive. I guess the good news is in the Ginnie program, what's different is they have the facility they're setting up to make advances that servicers can tap into to make those advances. And then FHA has a thing called a partial claim. So at the end of the 6 months period, the servicer will then submit a partial claim to HUD for all those advance payments. HUD then pays the servicer out of the MMI fund, Mutual Mortgage Insurance Fund, and that pays off the line that Ginnie's holding. So HUD is surprisingly better prepared for this. The GSEs can take care of this in the exact same way. They just got to step up and do it, and they could literally do it in a number of days. My own sense is that's coming at the direction of the regulator. I can't say that for certain, but my guess is that Director Calabria and the team at FHFA, they're deciding and controlling what they're going to allow the GSEs to do to deal with this issue. But I can promise all of you, if there is not something done here, we're going to see the failure of a wide variety of mortgage bankers in America, particularly non-bank lenders that have supported our communities and this nation's housing for the past many years. And that would be a dramatic disaster. And the sole thought, this would be solely due to this administration, and be their sole fault for making that happen. So we got a big deal here, man. And it's something that you're going to see a lot of people writing about. Major media is covering it right now, and it'll be the story through the weekend and through next week. And hopefully, calmer heads, rational thinking will come to prevail, and this administration, particularly FHFA and the Treasury Department, which could have a role here as well, will step in and make sure we get the liquidity needed just to do these advances. There's absolutely no rational right or reason that a healthy industry like America's mortgage banking industry, which had great credit quality borrowers, is now thrust into a recession that has nothing to do with what housing or housing finance did. It's brought on by a virus, only to have the government step in with an extraordinary package to bail out consumers, maybe more than even needed it, and yet thrust all the billions of dollars of risk onto our industry. It's impacting all of us right now. It's impacting your credit terms, products, MSR values, MBS bid-ask spreads are widening out. We have investors just pulling away from the mortgage market, and that's why you're seeing everything evaporate off your rate sheet, because people are really worried about what's this going to look like. Are these institutions going to be around? Who's going to ultimately default? And that's all that uncertainty has to be settled by the administration.
So, and one of the things you talked about actually is proving hardship. Now, to me, it's so fresh in my mind, remembering like the Hope Now Alliance event at Nassau Coliseum. We went down to cover it, and because borrowers were unable to get a hold of their servicers, and it was like a heart-wrenching thing. See families online as they were going through foreclosures because they just couldn't get on the phone with the servicers. I mean, servicers went from like a default of like less than 1% to like 10%, and just that clogged the system up so bad. So if we, I mean, and I guess what was the intent, to basically not have to prove hardship, so you don't have that bottleneck. I mean, what was the what was the good intentions of that, and could that also like the fact actually that if we do go to something where you have to prove hardship, could it set us up for a situation like 2008 or 2009, I should say, when everyone was trying to get loan modifications or forbearance or any kind of things like that?
Well, remember, that was an entirely different credit event.
Yep.
We had unsustainable mortgages that created that mess. It had artificially inflated home prices. Home prices dropped 24% from peak to trough in this country. We had homes underwater. We had people out of work. And the variety of packages that were offered to consumers to allow them to stay in their home it included a lot of programs under HAMP, forbearance, short sales, you name it, that were deeds in lieu. I mean, there was all sorts of things that were put into place. And yes, the servicing industry was not ready to handle this. In the end of the day, what's different here is it all goes into effect right now. So we went from 0 to somewhere between 10 and 25% of portfolio asking for forbearance. And in my view, it's immoral for the taxpayer to give away money to someone who doesn't need it in this incident. So they're already giving away the $1,400, which is, I guess, fine. Even to those who are fully employed. If I get a check, I'm going to donate it. And because it would anger me to have that put into my bank account. And the idea that we would use taxpayer dollars when we already have such a deficit here to simply give a freebie mortgage payment when it's not needed in any way is completely irresponsible. So it is different today. If you go to any of the websites of the servicers, no one's making phone calls. You could sit online for 3 hours today trying to get through to a servicing department. It hasn't, that delay is about the same, but this is far more automated right now. And if you needed to prove hardship, you could ask for a hardship letter, evidence of job loss. I mean, you could make these things basic without having to overcomplicate them. But it wasn't the forbearance plan that caused the servicer delays back in from 2008 going forward. It was an ill-prepared servicing industry, a lack of technological solutions, no waterfall of interventions that would be provided, where today the National Servicing Standards rule under CFPB have those in place. So it is a very different picture. But again, I'm just going to go back to the fact, any fiscally responsible American should be concerned about, just simply giving away all this money to people who just don't need it. And when it should go to those who do need it. And more importantly, because of this, they're saddling an extraordinary burden on our industry that should not have been there. Or if it's going to be there, it requires the government to put a solution in place to cover that liquidity need that they created.
Yeah. So, and I just want to go back to something. So we were talking about, like housing values. Obviously 2008, the housing values just artificially, inflated just because of crazy lending standards. And from that, I mean, so many of these borrowers were underwater that they didn't have options that they might have had previously. I think that's what caused a lot. Now, obviously, this is something, like you said, has nothing to do with actually the financial services business. It's nothing to do with, the mortgage
economy
industry
at all.
Yeah, it's nothing to do with the economy at all. But talk to us about your feelings about housing values overall. Like, are housing values going to take a hit? Are we going to see actually? And it's difficult to predict, but do you see actually this being a big burden on housing values?
It's so several economists are putting out forecasts, and MBA is just has completed theirs. Ivy Zelman has a look forward. Mark Zandi has put out paper from Moody's Analytics, and this is going to be a very different kind of event. And if you can see my slide, Andrew, is this up?
Yep, perfect. Thank you.
So this is one base case look. This is from Moody's Analytics. It just came out on the 27th of March. It won't be perfect, but I want you to think about what we learned in economics, if you took economics, was various recession curves. So is it, we used to talk about U curves or J curves or Vs. Take a look at where it says United States March update and go over to 2020 Q2. That's the quarter that we just started. It's 3 days old. What's the day today? It's a couple days old. So just at the beginning of this quarter, and the forecast is for a sharp decline in GDP, negative 18.2%. Then I want you to go out to Q3. It shows a bounce back, not bouncing back all the way. We're still going to have a longer residual effect than anybody wants. We'll have higher unemployment, probably high single digits overall. Not everybody will be reemployed immediately anyway, but they will over time. I could show you other forecasts giving a longer view on employment on another slide, but this is a different event. Everybody was sent home. Restaurants can't operate. Landscapers who are just beginning their summer season to build fireplaces and walls and pools or whatever else they're doing, their people have to stay home by order of governors. It doesn't matter what industry you're in, you're being forced to stay home. Retail across the board, shopping malls, residential retail, everything is stopped in its place. And while some people are struggling through with takeout and curbside pickup and things of that sort, for the most part, these places are all closed. So that's what is killing productivity, and that's what's stopping the appetite for participating in the economy. But when we all go back to work in a couple of months or 3 months, we're going to see an immediate demand surge, and that's why it goes from negative 18 to positive 11. I think the MBA's forecast is slightly different, but it's a similar kind of response. And you're going to see immediate growth back. It won't go back again to the way it was. We're going to go back to, sorry, I'm trying to pull up another slide here for you in a second. But we're going to go back to a much better economy than we were before. Now, a lot of this depends on, will we have a round 2 of Corona in the fall? Will we have come up with any treatment for it that's more effective? But there's going to be huge pent-up demand. I mean, Ivy Zelman talked about apartment dwellers who are going to come out of this saying, I'm moving out to the suburbs. I'm never going to spend 3 months again in a 900-foot, square box high-rise. So, it's going to be interesting to see what happens here. We have a very different kind of dynamic that's facing the demographics of this country right now. This is a slide that might be helpful. If you go back to 07 and 08, which was the Great Recession was obviously started in about 08 is when it was officially recession. This is household formation. This is reported by the Harvard Joint Center for Housing Studies. But if you look at the red lines, that is rental growth. That's household formation, that's rental. And blue is household formation that's owner-occupied, meaning purchase. For those many years, from 07 through about 2013, we were losing owner-occupied households every single year through that entire cycle. The only growth was in rental households. And that's really all a result of the millennial generation. They were too young to buy, but they were starting to rent. And so we were seeing a net loss in owner-occupied households. So not only did we get hit with a credit recession brought on by unsustainable mortgage products and people who shouldn't have bought homes and huge artificially inflated home values and all of that many great movies were made about talking about that period, we didn't have demographics to support the housing sector at all. Now go to the right side of this chart, go to 16, 17, 18, and they'll update their 19 slide in this year's report that they're going to put out. But we've now seen growth rates in owner-occupied housing of 1 million plus, and we're actually beginning to see net losses in rental housing. That's because the millennials are older, they're in their 30s, they're buying homes, and this is just math, guys. This is a reality. So what's different between this economy and home prices to the last one? The last economy, we had an excess supply of single-family residential homes, an excess supply, so much so that large Wall Street firms bought up tens of thousands of them and put them into securitization rental pools because there wasn't the demand. And we had no demographic to come in and buy it. And we had huge credit weaknesses that invaded the entire economy. This time we had a virus. We had a super strong economy. We have extraordinary household formation with demand, and we have a shortage of available inventory. In fact, shortages that are alarmingly low. And prior to COVID, everybody was writing stories about how we don't have enough available inventory to support the housing sector. So this is why you're going to hear economists talk about, while there may be some pockets of downturn take places like Las Vegas, it depends on the hospitality industry, and it may be a little slower before people hop on jets to go to casinos and go back to Las Vegas. I don't think it'll be that long personally, but we'll see. But it'll be longer, perhaps. While we may see some stubbornness in the jumbo market, that was always already showing some stubbornness. We have a lack of inventory of entry-level homes and a huge demographic need that's going to demand household formation, whether rental or owned. We have a massive influx of people in their 20s and 30s who need units. So I'll give you an example. My home, I have 4 kids. In the last recession, we were 1 household. Now we're 5. And that's what happened to all of us across America. It's created huge demand. And we saw that with the baby boom generation, of which I am one of. That fueled the entire industry that we're in from about 1980 going forward. The millennial generation is bigger, and they're in that peak cohorts right now that for housing demand. And that's what we just had a few short weeks ago. That won't change when we come out of this. These millennials want to get in their homes. Realtors are telling me their phones are still ringing, asking, should I buy, but how do you buy virtually? And all those conversations are going on. But for the short run, it's going to be really hard because we're going to be watching the news every day, just in shock and heartbroken and sick over what's going on here. We're going to be worried about other things other than this, because we have family and more that we have to care about. But when this is over and we all go back to work, which is just going to be a few months away, you're going to see immediate activity coming back in the marketplace. And if you look at some of the forecasts looking outward for employment, it continues to grow. And I won't bore you with another slide unless I pull up fairly quickly, but
please do.
This is another one from a different Moody's presentation that just came out literally a couple of days ago. And I don't know if you get Moody's research, but you could find it online. But this is using Bureau of Labor Statistics and Moody's Analytics. And they're looking at employment. And the only thing I want the numbers will never be right exactly because they're attempting to forecast. But you're going to see a huge increase in unemployment that's shown by the spike in the line and a huge loss of jobs in this quarter. You're going to see a big spike back because the initial reaction of everybody going to work is going to put just a big slug of people right back into their jobs. Not everybody, but a slug of them are going to be able to go right back to work. I live in the Washington, D.C. area, and there's hundreds of thousands of federal contractors, but their contracts don't get paid if they're not working. So if their contractors send them home, they're not going to work at federal agencies. Many of them aren't getting a paycheck for a while here. So, and that's just an easy example. Teachers will go back to school. Most of them are getting paid, but again, I'm not going to go through all the industries. But if you look at the employment, the blue bars going out, look out through 21 and 22, you start to see steady increases in employment each quarter. And that's why the green line, which is the unemployment rate, we're going to get a little bit of improvement immediately that first quarter. It'll then worsen again month by month because the big slug would have gone back to work of people. And then we'll start to see it improve quarter by quarter, again, with unemployment, with the unemployment rate going back below 5. So the point here being, this is just a very different kind of scenario for all of us. It's shocking. It's almost hard to believe that we'll recover from it. But we came into this with one of the strongest credit economies that any of us have ever been to in our careers, piled on with some of the best demographics for housing that we've ever had in our professional careers, and really low interest rates. I mean, we were literally right in the center of the perfect scenario for what we all do as a living. But when we come out of this, we're still going to have that demographic picture. Yeah. Businesses are dying to reopen. They're all dying to reopen. Every restaurant can't wait to get tables outside, whether they get filled the first day or get filled over weeks. That's going to be a question mark. But I think a lot of people are going to want to go back and sit on an outdoor cafe and have a glass of wine or something pretty quickly. And we'll see how quickly that is. But the economists are building that into their value prop, their forecasting. Yeah. And then on top of it, the Fed, which intervenes so strongly, is going to make certain that while we'll still be in a recessionary environment because of all of this, they're going to make sure that it recovers as quickly as possible. So you should expect mortgage rates to be near record lows. When you look at the MBA forecast when it gets released, you're going to see home purchase activity will be a little weaker going forward here for several quarters. Yeah. Still not terrible, but a little weaker. But you're going to see refinance activity forecasts looking pretty good because the expectation is that rates are going to remain really low. So, this is not the Great Recession, and it certainly is not the Great Depression. And we can make sure that doesn't happen by putting pressure on the administration not to wipe out a whole sector of America's industry, like mortgage banking. But again, that's just a perspective.
Yeah. So, I mean, listen, the picture painting is not as ugly as some are making it out to be. I mean, obviously right now we're just going through some hard times. I mean, like you talk about it, people are looking to go back to a restaurant. I just want to go to, a supermarket without a mask and gloves. I mean, that would make me happy if I can just do that. So let's talk about, a couple other things I wanted to ask you about. But one of the things I'm just wondering, let's talk about the opportunities that are going to come out at the end of this. So you talk about an amazing refi boom. Do you see actually, opportunities with renovation lending? I mean, people are sitting in their homes, spending all the time actually looking at their homes, their kitchens that they're maybe not happy with. Things like new home offices, since now for many this is the new norm. Do you see opportunities, and what other opportunities do you see?
Well, look, I don't do mortgages anymore, but I'll give you just a few thoughts in general about this whole thing. Yeah. First of all, Andrew, any loan officer watching this is going, where did all my products go? Wells Fargo announced that they're exiting the jumbo market. I think others followed as well last night. So correspondent jumbo. So they're going to do jumbo, I think, for their retail only. Yeah. But that took out a huge source of product, and others are going to obviously follow. You're seeing FICO floors rising, minimum FICO floors rising. We're seeing real concern about getting in the FHA program in general, because bids on Ginnies in general, it's really difficult to sell pools of government loans right now in this marketplace. And high loan balance agency, so the stuff that's in high cost markets where you have the higher limits. Some lenders are shying away from that. Co-issue market is gone. Obviously, the non-QM market's gone. So you're now dealing in a world where your probably safest place to play is Freddie, Fannie, conventional space, and that's pretty much about it for right now. So we're going to need to see these products come back to think about refinance booms and using kind of rehab lending or 203Ks or whatever it may be in your business. I do think in the end of the day, we're going to walk back to a whole bunch of consumers who are saying, I still want to buy a home. And they're going to be anxious to go out and buy a home. I think you're going to see a bunch of people who are saying, a lot of my wealth was wiped out. And you'll be able to look at cash out refinances, I think, as an opportunity to get really low cost dollars and allow them to put that back into some sort of investment plan over time. So I think there'll be a refinance strategy that's going to work in that sort of in that direction. And in the purchase market, I'm just going to go out on a limb here. We're going to need to help those who don't have down payment money buy homes. And so I think we need to look at responsible ways to do things like down payment assistance programs in a way that's much more sustainable over the long run. And I'm currently looking at those programs right now because there's some really great creative approaches there, because if we can help people get into homes easier in a much more sustainable way using housing counseling and reserve requirements and things of this sort, we can really help people get back on track in home ownership. And then, in the end of the day, we're still going to walk out of this thing with a shortage of supply. And there's just a natural floor at the entry level point where you're not going to see home prices drop. So, and just because there's nothing else out on the market. And so we're going to need to still focus on how do we create affordable, available housing for new home buyers. But it is going to be slow. It's going to be bumpy coming out. But it's going to be, it's going to be nowhere near as bad as the calamitous forecasts of, here comes the Great Depression again that some are trying to sensationalize. So we just need to keep our heads on straight and focus on our business. And Andrew, if I could just say this, everybody here is coming off one of the best months they ever had last month, March.
It's unbelievable.
It was a huge month, and we didn't expect this kind of month 8 months ago. We ended up having this interest rate rally that nobody expected, and we were heading into one hell of a spring market, which unfortunately has been shot. But at least you guys all started off with a really good year, and you probably have a pipeline that's not bad for the month of April. Let's get through that. Let's see when we go back to work, and please do not panic. Share information with your realtors and your referral partners, and start thinking about a business plan to help people who are thinking about listing beforehand get their homes on the market quicker after this is over. Help those who are thinking about buying realize if they go jump in pretty quickly after this is over, if they're able to, they won't be hit with multiple contracts and getting kicked out of their attempts to buy a home. So there's going to be opportunities here. It'll come to those who understand how to capitalize and could put good work ethic and enthusiasm together to try to make a market for themselves.
Now, and just jumping back to the forbearance thing, because we have this potential opportunity for a great, actually, recovery as soon as we're allowed to go back outside again. We know it's not going to impact our credit report. Our scores are going to be okay, but will lenders look at our mortgage history, and is there a way that they're going to carve out and say, listen, I know your score is actually okay, but there's a forbearance on here, so will that impact some of actually the purchases or refinance or renovation lending that's done at the end of the year?
Well, that's a hell of a good question. And I don't have an easy answer for that one. The credit bureaus have sent out clear directives that servicers are not to report these as late payments. And if you look at the HUD policy rollout that came a few days ago, it's very clear on that document that as long as they were current as of the month prior to going into forbearance, then that loan should be considered current and reported as such for that 4 months. The worry I have, and I wish we could talk to every homeowner in America and just make them think about it for a minute, outside of the negative equity they're going to be creating if they take forbearance and don't need it.
Yep.
The worry I have is if they go to refinance and there's some odd lien behind the first mortgage or some payment plan, will the creditor, the lender, say, oh, are you on a forbearance plan? And will that change their underwriting standards for a new loan? And I have heard from one originator already that they will not entertain any new loan that's in a forbearance or that has been in a forbearance as part of their policy. I'm not sure how that's going to be reported necessarily, but I do think that once you do an initial title search, it's going to become pretty clear, or at the payoff request, that something different happened here, and that is likely a potential forbearance. And I'm not sure if even lenders going to be asked to ask the borrower directly in part of their upfront, process. Were you ever in a forbearance plan? Not sure that'll be allowed either. But my own sense of this, it'll be pretty easy to discover a borrower who took a forbearance plan. And while it wasn't reported to the credit bureau, I think that then comes down to, will credit underwriters want to look at that loan differently? Will investors want those loans pooled in a different way? Will it cause a problem for that individual getting a loan? And none of us have that answer. None of us right now do. Another one of the reasons why I really think forbearance plans sponsored by the federal government should only be used for people in need, and not put in such a way to create the kind of moral hazard that I think this policy creates.
Yeah. So the message for originators out there is, tell your borrowers, do everything they possibly can to pay their mortgage, because it's not a forgiveness. They're still going to have to pay, those payments, whether it's a lump sum at the end of that term, or it's added to the end, or, done whether it's paid over X number of payments. You still have to pay that, and there is going to be a record of that someplace. Whether it's used against you, that remains to be seen. Is that pretty much a fair
I think that's right. And the GSEs are more likely to establish a payment plan pretty quickly after the forbearance period. HUD, you can pay it off if you want. You can always pay off anything you want to early. But the way the HUD forbearance plan works is, once the servicer puts in the partial claim for those forbeared parent payments that were advanced to the MBS holder, they record what's called a secretary's lien onto that note, and it becomes payable at either refinance or time of sale of property. And in that particular case, my concern here is, if you don't need to do it, you really shouldn't. If you bought that home at 3% down, almost half, or north of 40% of all purchase transactions for FHA last year had down payment assistance, which is a huge percentage. So if you had no down payment or 3% down, you miss a couple mortgage payments, you're negative equity already. And 6 months worth, a year worth? Are you kidding me? How are you going to be mobile when you want to move up to the next home, and suddenly you have to write a check at the closing table? And it's sort of smacks against everything we believe in terms of real estate as a wealth building investment strategy for the long run. And that's going to be one of the challenges. And again, for the GSEs, if it becomes an immediate payment plan, you're not going to have your mortgage payment, but now you're going to have this new payment to make, in just a few short months. And so, my own sense of this thing is, we can go a long way educating our consumers. And I would say this for all of us: we have a responsibility to encourage anyone in need who can't make that payment to take advantage of this forbearance plan, because it's a great deal if you need it. It's a great program, and it's a hell of a lot better than all the other options that are out there right now. So you want it available for that family in need. You just don't want to abuse it.
Wonderful. So listen, I'm going to hit you with one more thing. A little bit earlier today, I spoke to a mutual friend of ours, Tony Thompson, president of the National Association of Minority Mortgage Bankers. He's just has a lot of concern, about, minorities specifically, being, impacted by this. I mean, obviously, the non-QM was a product that was really, really helping actually minorities, increase their home ownership rate, and some of the the lower credit programs within actually government lending also actually allowed actually an increase in minority home ownership. So the question is, do you think actually will we see a return for non-QM, and do you think actually after this is all done, we'll get back actually on government lending down to the low FICO scores that we were going down?
Well, yeah. So and by the way, Tony does an amazing job and has put together a great organization. This virus is hurting African Americans in a unique way. Not only is it for some reason higher risk in with men than women, it's higher risk for African Americans than other minorities, other demographics, which is just an interesting data point. And when you look at the impacts of an event like this, it hits those hardest who don't have the reserves saved to get through a time like this. So those that are out of work, who may have mom and dad with money, or may have had savings, available net worth to tap into, they can get through this period. But in this country, the lack of inherited wealth to be passed down generationally to African Americans is really incredible. And when you look at average net worth between white non-Hispanics and African Americans, it's a multiple difference, many multiples of difference between the two. And a lot of that has to do with how this nation was formed. And I think we have an obligation to find ways to help the African American community build wealth in some form of affirmative way, because that's one of the greatest means by which you gain wealth and pass it on to your children. I was looking at the Chenoa bond program the other day. I'm looking at some of these down payment assistance programs, and the Chenoa program, when I was looking at their data, not only is a high percentage of their down payment assistance program going to minorities, I think 40% of all, 38% and change of all their purchase transactions this past year, the borrowers were the first generation in their family to own a home.
Wow.
So, we need programs, and we need to think about programs that will combine sustainability features to make sure they have long-term survival in a manner that allows access to home ownership going forward from those who otherwise are boxed out of that market altogether. So to that end, yeah, we need FICOs to be lower and to be able to come back. Right now, obviously 640 is the floor. In some cases, it may be 680. I'm not sure where that's going to bump around here for the next couple of weeks or a few weeks or a couple months. But ultimately, once we understand how everybody performed during this cycle, who ultimately went to default, we're going to be back focused on equality of access to home ownership, because ultimately that's an incredible wealth building engine for the future of our country and the future of so many American families. And that's how you pull people out of poverty. So in the end of the day, we should have great concern for particularly the African American community and the Hispanic community, because we haven't seen great improvement in home ownership rates for generations. And that's an area that I think we as a nation are going to have to really seriously look at, even more so coming out of this crisis.
Yeah, it's a crisis on top of a crisis. So yeah, wonderful. So listen, David, I appreciate you. I just looked at the time. We've been talking for 53 minutes. I could actually, there's no actually shortage of information coming from you. And I know actually, you're having conversations, with the Fed, actually with the Treasury. You're talking and engaged as much as you possibly can. And thank you for all the work you're doing to try to actually bridge industry, and government. It's always been actually just great having you as a leader, actually, for the some of the biggest brands in the mortgage business. Obviously for the MBA, when you were at the helm at the MBA, and also when you were part of HUD. It was nice to see we had someone actually with the level of your competence there at the helm. So thank you for everything, and for continued leadership as we're going through all this. I think this is the time actually that us as an industry need to be as vocal as we possibly can, sharing actually information from people like you. And you've been all over the place doing actually interviews all over the industry. I mean, we're blessed to have you here, but I just, like, it seems every time I look at the Facebook, there's another great interview that you've been a part of. And I just encourage all the originators out there, take some of the information that you're learning here, and start to actually share it with your community, share it on Facebook, record videos. It really doesn't take actually much much to be able to do this. I'm in my basement. There's laundry over here. Like there doesn't really take anything. Just so you know, David's actually not at the Capitol. I don't know if anyone actually was fooled by that, but that's he's in comfort of his home office. I hope I didn't ruin anyone's, I didn't ruin actually your hoping to kind of keep that mask on there. So we got people actually thanking you for your time. So Dave, thank you.
Thank you, man. Take care, everybody. Have a great weekend. And let's all stay safe.
Yep. And as Faith Schwartz said earlier this week, said everyone, let's breathe. Let's breathe.